Hi, I'm Kieran O'Dwyer, Vice President of Corporate Communications at Mutual of America Financial Group. Thank you for joining our year-end Economic and Market Perspective webinar. Just a quick housekeeping note before we get started. We'll display a QR code at the end of today's webinar so that you can download the slides. You can also access related content through the paperclip icon in this webinar. But today's webinar explores key factors impacting the financial markets, economy, and inflation during 2023, and importantly, a look ahead at what consumers might expect in 2024. This includes inflation's continuing impact. And while inflation's high of above 9% in the summer of 2022 is well in the rearview mirror, we know that Americans have continued to feel its effect on various fronts throughout this year, along with food, gas prices, high home mortgage interest rates, even impacting retirement savings accounts, just to name a few. To combat this, in the first part of 2023, the U.S. Federal Reserve continued to raise interest rates in its attempt to cool the economy, reduce inflation, and avoid a recession. But it has essentially left rates unchanged since the summer. With that as a backdrop, as always, to provide his expert insights and analysis, please welcome Stephen Rich, Chairman and CEO of Mutual of America Capital Management. Thanks for joining today, Stephen.
Thanks for inviting me again, Kieran. I always love discussing the markets and the outlook.
Great. So I would say there's so much that's happened this year, but I think as we've done in some of our past webinars, Stephen, let's start by looking at the performance of the financial markets this year, and in particular, the equity or stock market. It seems hard to believe, coming off nearly a 20% decline in 2022, that impacted so many 401k and 403b retirement plans. But this year's stocks had posted a 20% return heading into December. Can you give us a characterization of some of the nuances that occurred this year and whether this trend might continue in 2024?
Thanks for the question, Kieran. So from the slide, we can see that in general, equity markets have been positive for the year. The equity markets, however, have been quite narrow. And as you can see, the best performing parts of the market were the NASDAQ, which tend to be more growthy and have quite a bit of tech exposure. If you look at the S&P 500, it's returned 20.8%, which is a very strong return. However, if you look at an equal weighted result of the S&P, the return would only be 6.6%. And so what this tells us is the market has been very narrow. And in fact, the market has been driven by what's been termed the Magnificent Seven. And these stocks are the largest stocks in the index. And they also have one commonality between them, that they all have exposure to AI, or artificial intelligence, which was a very strong theme over the course of the year. So in general, growth was outperforming value, and large was outperforming small cap companies. In fact, prior to the rally that we saw in November, small cap stocks were actually flat to slightly negative on the year. And so this has been a tough environment for these smaller cap stocks. And we would assume that going forward, that small cap stocks should be able to catch up with their larger cap brethren. And that's one of the areas that we would, in fact, focus on for next year.
Could you just dive a little bit further into the mega cap stocks that have done so well, and how that really has added more risk to the index through that concentration you touched on?
Yes, probably best explained by this chart. And what this chart is showing us is that the top 5 stocks in the S&P 500 index make up 25% of the index, which is at a all-time high. And so what this means is that the very largest stocks have very high concentration within the index. as a result, that makes the index very risky, because if one of these companies does go down in value or significantly down in value, it will have a disproportionate effect on the overall index because of this concentrated in these very large companies.
Great, thanks for the insight on that. And I know we'll keep a close focus on equities in the months ahead for sure. But I'd like to take a look at the bond market if we can, which really has been quite volatile this year. We've talked about this before, but bonds appeared on their way to a record third consecutive year of negative returns, but have rallied. Can you share some insight on what's happened to prompt this turnaround, even though they remain so volatile? And also, without getting into the weeds, as I know we can here, if you could give some insight into why the 10-year Treasury yield is such an important benchmark when looking at inflation.
As we can see from this first chart, that returns in the bond market have been less robust than they have been in the equity markets. And in fact, without a rally that we saw in November, both the Bloomberg aggregate and the corporate, which are now slightly positive, were in negative territory. You can also see that the longer duration instruments, the 10-year Treasury and the 30-year Treasury, are still showing a negative return for the year-to-date period. As just a bit of history, as you suggested, if the Bloomberg aggregate had finished the year in negative territory, it would have been the first time in history that the bond index had 3 consecutive years of negative returns. So we're quite happy that at least this index is showing some positive performance on a year-to-date period. So that's a good thing as rates have come down in the month of November. Now, if we turn to the next slide, let's just talk about the yield curve. And we have here two curves, one being the yield curve as it stood in December of 2021. And we have it as of the end of November, November 30th of 23. And you can see that there's quite a difference between these two curves and the shape. And so the current yield is what we call inverted, where short-term rates are higher than the long-term rates. And as we've mentioned before, an inverted yield curve has been a reliable predictor of recessions in the past. In fact, over the last 50 years, inverted yield curves have preceded each of the recessions that have occurred. So this is one of the anomalies that we've been struggling with this year, because we have not had a recession and we've had an inverted yield curve for quite some time. The question of why is the 10-year bond important, I kind of think of it as in two reasons. One being that the 10-year Treasury note captures what the expectations are for where inflation will be in 10 years' time. And because it's predicting the future and what expectations are, it tends to be a proxy for many financial vehicles such as mortgages, and also corporations in their modeling of their outlook oftentimes point to the 10-year Treasury as a way to measure the financial success of a particular project. So it's an important benchmark, and it's just one that people tend to focus on, and it's simply, as well as it's in the middle. It's not too short and it's not too long, and so that's why a lot of various financial instruments are priced off of it.
Great, thanks for the insight on that. And I do want to get to some specific goods and services that are impacting Americans. But before we focus on that, and I know that's something that a lot of folks in our audience are looking to hear as well, I'd like to look at some of the data that is measuring inflation. That is important. The most well-known is the Consumer Price Index. Let's first talk, if you will, about this government gauge and how it's resumed its downward move toward the Federal Reserve's target at 2% rate of inflation and why that's important. And then let's look at some other key government indicators.
Yeah, I think this chart tells the picture pretty well. If we go back to June of 2022, we had CPI at the highs of 9.1%. As we look to the current period, you can see that that's been reduced fairly dramatically, landing at 3.2% at the end of October. And so we've seen great improvement over this year. However, the Fed's stated target of 2%, we're still outside that range. And so this is kind of the back and forth between the data, where it's going. It's been trending in the right direction. We believe it will continue to trend towards that 2% level, but it's not there yet. And so that's where the markets become a little bit volatile, because there's a back and forth between has the Fed done enough to bring inflation down, and all signs seem to be indicating that they are making progress and it is going the right way. But we're going to have to wait to see how this data continues to unfold, especially as we get into 2024. As we look at some, other measures that the Fed looks at, we've mentioned this before. Obviously, we just covered the CPI. The second one is the PPI. This has also improved dramatically. This stood at 8% in October of 22. And then probably the preferred measure is the PCE, the core PCE. And once again, this has made quite a bit of progress over the past year and continues to trend downward. And so, these are the three basic gauges that people at the Fed focus on. But in terms of CPI and core PCE, these still are above the 2% goal.
Definitely a lot of data to keep track of, and it can leave your head spinning. One thing I do know, and I think we all agree on, is that there are some core issues that have affected American consumers on a daily basis, really since inflation kicked in. Most notably, I would say food, gas, housing. We see this every day at the supermarket, the gas pump. Let's start with food. I know prices have declined significantly over the last year. It may be hard to believe, but they have. But they do, and maybe that's because they still remain elevated above pre-pandemic levels. Is it fair to say that costs are not likely to return to those pre-pandemic levels, but that price increases have stabilized or even faded?
That's a great question, Karen. So let's look at some of this data. And what we can see is that food inflation has definitely cooled from a year ago, where we see prices of these selected food groups very elevated. And we can also see that these have also come down from those elevated levels over the course of the year. The problem for the consumer is that while the rate of change is slowing, the absolute costs from a year ago remain high. Just giving one example, if we look at the cost of eggs in a pre-pandemic period, a dozen cost $1.47. If we go back to the beginning of this year, a dozen of eggs cost over $4. Currently, we find that eggs are at $2.07. So it's clear to see that eggs remain elevated and will continue to be elevated because of the inflation that's been put into the system.
And same with gas prices, which alongside oil is a major factor of inflation. I mean, the numbers show big declines from all-time highs last summer. But again, it's still ticking above where we were even at the beginning of this year. Overall, though, what's driving these declines and what that might look like heading into the new year? And I know it's seasonal, Stephen, as as gas prices tend to be.
Right. As you suggested, gas prices have come down from its highs, but gas, as the title of this slide, still remains above $3 a gallon. And so we see improvement once again, but on an absolute basis, gasoline is still high. And gasoline and energy costs in general, can be quite inflationary because this touches all parts of the economy and works into almost everybody, whether it's going to the gas pump to get gas to drive to work, or if you're using if you're a business or a company and you need a certain amount of power to make certain products. So all of these inputs will be inflationary. They continue to be inflationary, and these parts of the economy continue to be somewhat elevated from where they've been historically.
And even one more touch point I want to focus on is a little bit into housing, but mortgage rates, for example, they've eased a bit, but as the slide shows, they're quite high. They're at highs not seen really since the early 2000s. How much has a slowdown in home buying due to high rates help the Fed's efforts to ease inflation? And also, what should we be taking in terms of what we look at with regard to the high interest rates?
Yeah, so interest rates are one of the things that is affected most by the Federal Reserve raising rates. I referenced this earlier. 10-year mortgages key off of those key rates set by the Fed, and mortgage rates really do continue to weigh on the housing market, and it's really twofold. New home sales continue to struggle, and the term in the market is that the market's frozen. And so on the one hand, you have buyers who are looking to purchase homes. They've got much higher mortgages than they did in the past. Secondly, you have sellers who have low mortgages that aren't interested in selling their homes. And as a result, prices continue to go up. And so sales are actually at their lowest level in the last 13 years. And so, as I said earlier, the market's really kind of frozen here. There's not as much activity as we've seen in the past. And so higher mortgage rates are definitely having an effect on the overall economy.
Great, thanks for giving us some insights on some of those consumer-driven issues that we've been facing, and I'm sure we'll continue in the year ahead. But I just want to shift gears a little bit to talk a little bit about the Fed interest rate hike increases. Earlier this year, the Fed did continue its aggressive position that they started in 2022 of raising interest rates, but they've largely stopped since the summer. I know you've touched a little bit on this already, but is it fair to say that the impact of these rates is finally working its way through the economy? And what would keep the Fed from further increases?
Yeah, Kieran, you're precisely correct. The Fed has been on pause since July, and this is after raising rates in 2023 by a total of 1%, that being 25 basis point increases throughout the year. And, the market seems to be digesting the data that this may be the potential end of the Fed's interest rate hiking campaign. This has actually, I think, helped the markets tremendously in the month of November and in the first part of December. And the market is actually pricing in an 84% chance that the Federal Reserve is going to cut rates by its May meeting. And so the market at least is reading into the Fed's pause as being that they've done enough in terms of raising rates, and they've pivoted towards looking for when rates will begin to get cut. Now, time will tell. This will all be data dependent. There are lots of pushes and pulls in the market, but that's what current consensus thinking is as we stand here today.
So one thing that's been kind of weighing, I don't know if so much weighing on the interest rate hikes, but has been a factor is the job market. And so I just want to ask you on that front, with regard to the job market and employee wages, they've been so strong for so long now, and unemployment rates in the US remain relatively near to historic lows, but we are starting to see some cracks beginning to show. We know the Fed wants to avoid setting interest rates in a way that you mentioned about that may negatively impact the economy and risk higher unemployment. So where do things stand now for jobs heading into 2024, and maybe also give a little backdrop on what's happened up to this point?
Yes. Well, the unemployment rate has been a bit of a thorn in the Fed side because unemployment has continued to be low. And as you can see from this chart, back in 2020, unemployment rates were 3.5. They've ticked up slightly to 3.9 at the end of October. We would think that as the Fed continues to have a tightening posture, where we've just looked at interest rates and what they've done, that this will continue to the unemployment rate will continue to move higher. We are not in the camp that we have runaway unemployment, in part because wages have been quite strong, which has helped the consumer. Wage increases on an hourly basis are up 4.1% year over year, and so that's a pretty healthy number. So in general, the labor markets are pretty healthy, and we would continue to believe that the labor markets will be as we go into 2024. And I think the next slide kind of addresses some of the reasons why we believe that the labor market will remain pretty strong. And this is a chart looking at the GDP, the real GDP. And as you can see that the last reading for the GDP, which was third quarter, this number was running on an annual basis a little bit higher than 5%, which is a pretty robust economy, which will keep people fully employed. And this is also another data point that people have been reading into, which speaks back to why we think that there may be some sort of a soft landing here, because the Fed has tightened, they've brought down inflation, but yet the economy remains robust and unemployment remains relatively low from a historical perspective.
Well, thanks so much for insight on that. I quite honestly, I can't believe we've run through so much of this information in such a short time, and I feel like we've really only scratched the surface, but I do appreciate it. What I do want to just talk with you on now is just, with all this information, with all this data, with all the things that are happening with the economy and the market, the bottom line is that Americans continue trying to make sense of what's happening with the markets, with the economy, and other issues, quite frankly, in the US, such as the upcoming presidential election, the wars overseas, geopolitical issues, and how these are affecting their spending and their ability to save. So with all of that in mind, Stephen, what should we all be on the watch for in the months ahead as we look at 2024?
Great. So I guess the first point is that we believe that the Fed will remain vigilant in terms of taming inflation, and also trying to avoid a recession, which is really this soft landing kind of concept. And so I think the Fed is quite on top of trying to engineer a soft landing, which would be quite positive for the overall economy. The second point is that we believe that there will be continued volatility in the market, and that would be both on the equity side and the fixed income. And it's made mainly around this idea that while interest rates may in fact come down, during 2024, they may not go down to the levels that we've seen over the last 10 years. And so how do these markets operate in a higher rate regime? So I think that creates some amount of volatility. I also believe that volatility is created around all of these pushes and pulls in terms of the data. Markets seem to be very sensitive and endpoint sensitive to various data points. So this will continue to keep, I think, some volatility in the market. And then my final point here is that real GDP, wage growth, and the labor market all continue to be strong. And so if these stay intact, then my belief is that there is the potential for a soft landing as we go through the balance of the year. And that would also be, I think, a very good outcome for the U.S. economy. And as you had mentioned, there are some wild cards that are going to play out over the next year. The first one being the presidential elections. There's always volatility around that. And then the second, and probably even less predictable, is the geopolitical tensions around the world, whether it be the Russian-Ukraine war or the Israeli-Gaza. And so there's lots of reasons why there can be outcomes that aren't currently being, predicted, at least by consensus thinking.
Well, thanks for walking us through these important issues as we look into 2024. And I know this, you'll continue to keep us updated on this as we have more webinars throughout the year on these specific issues. So thank you, Stephen.
It's a pleasure to be here, Kieran, and I wish everybody happy holidays and a great 24. And hopefully we'll be back early next year to review what the markets are doing.
Great. Thanks so much, and happy holidays to you as well. Thank you all for taking the time to watch this webinar today. As I said earlier, you can use the QR code to download the slides, and related content is also available through the paperclip icon on the screen. Finally, please know that this webinar will be available soon at mutualofamerica.com to watch at your convenience. With that, please take 1 minute to complete the brief survey, and thanks again for watching, and have a great day.